All right, so here we go. We're doing life insurance basics. An individual I accidentally answered the right question. An individual applied for an insurance policy and paid the initial premium. The insured issued a conditional receipt. So paid the initial premium, got a conditional receipt. That means if he dies, he's gonna pay, right? 5 days later, the applicant submits a medical exam. If the policy is issued, what's the effective date? On the date of the medical exam. That's why it's a. You see that? So if there's no medical exam needed, then the issue date is on the time of application, which is D. But in this case, there was a medical exam, so the answer is A, on the time of the medical exam. All right, let's keep going.
I had a question about the first
Question, go for it.
I heard that they give you the medical exam. Like, it's not required. Why do they give it to you?
Sometimes it is required, sometimes it isn't. So when is it most likely required? When you're getting high coverage. When you're getting high coverage, they're gonna ask for a medical. Like every company is different. In the test world, that's not a question that's gonna come up in the test. Okay?
Oh, okay.
Pero in the real world, like Primerica, for example, if you have $300,000 in coverage or more, you're gonna get a medical exam. 9 times out of 10. Sometimes they don't require it because they check your medical records and you're like never been to the hospital. You have a clean record. Your height and weight is good. You're in the age group that is prime of people not dying. So they sometimes don't require a medical exam. So it depends. Every company is different.
Hey, Sasson. And if they're like,
and if it's
really
300,000 or less, yeah, it's not gonna require medical at all.
Okay.
You
so it's money wise, not medical either.
It's coverage wise. Mostly it's coverage, but there are issues that sometimes they do a medical exam if you just recently went to the medical doctor and they found out that you have high blood pressure, but it's really light. So they might want to send you to see how bad it is now. Your ¿cómo se llama? Your high blood pressure. Make sense?
Okay.
Good question. Keep asking. Ask a lot of questions. The more the better, because I'm going to answer them. This is being recorded, so this is going to be good for everybody. All of the following are duties and responsibilities of procedures at the time of application, except. So we're looking for the false answer. Following duties and responsibilities of producers. Perdón. A, change any incorrect statement in the application by personally initiated next to the corrected statement.
No.
Well, you are not supposed to initial. The client is supposed to initial. So that's going to be the false answer, which is the right answer. But before you answer a question in the test, it's good habit to make sure you read everything before you answer anything. Okay, so let's read all of them. B, explain the nature and type any receipt the producer is giving to the applicant. Yes. Probe beyond the stated questions if the producer feels the applicant is misrepresented. Yep, sure, why not? Check to make sure that there are no unanswered questions. Yep, so definitely it's A. See that? B, C, and D, you could kind of common sense those and say, yeah, those are duties of a producer. Producer, what is a producer? An agent. Somebody that is
Professional.
somebody that, like, you're getting your license to be a producer. That's the word for a life insurance agent. What is the purpose of a conditional receipt? The purpose of a conditional receipt, it serves as proof that the applicant has been determined insurable. No, conditional receipt means that your coverage is conditional based upon approval of the policy. But if you die during the underwriting process, you're covered under the conditional receipt. Under the condition of what? Under the condition that you would have been approved anyways. Does that make sense? So let's see which one says that. A doesn't say that. B, it is given only to applicants who fully prepaid the premium. I like that answer. Yeah, you have to have a conditional receipt, you do have to have a monthly payment, your first premium deposited. It is intended to provide coverage on a date prior to the policy issue. It is intended to provide coverage on a date prior to policy issue. That one's tricky. Okay, so I like B better than C, okay? C, it guarantees that the policy will be issued. No, it doesn't guarantee that the policy will be issued. B and C are my best answers, but I like B better than C. C is the answer. So let's read why, okay? So every time I get a wrong answer, dude, guys, every time I get a wrong answer, I want to read the rationale to understand. And therefore, in the future, I'm not going to get it wrong. And by the way, you asked me, how long did it take you? So you see, I'm still learning, right? I'm still learning. The good thing is, guys, that you don't need all the questions right to pass a test. You can get 1 or 2 or 3 wrong. In fact, in the test, there's 75 questions in California, right? In California, there's 75 questions, and you only need 45 right. That means you could get 30 wrong. 30 wrong. Crazy, right? Coverage commences on the date of the application or the date of the medical examination, whichever one is later, on the condition that the applicant is determined to be insurable at the rate applied for. So C says it is intended to provide coverage on the date prior to the, there it is. Yeah. Whose responsibility is to make certain that an application for insurance is filled out completely and correctly? Whose responsibility is it to make certain that an application, well, the producer, we just talked about that, right? The agent. An applicant is denied insurance because of information found in a consumer report. Which of the following requires that the insurance company supply the applicant with the name and address of the consumer reporting agency? Dang. I got it right. That was good feeling, but so the Fair Credit Reporting Act governs what information can be collected and how the information can be used.
What is that?
Governs, they control. They're in charge. It's their duty, their responsibility. If a change needs to be made to the application for insurance, the agent may do all of the following except erase the incorrect answer and record the correct answer. That's the answer. He can't do that unless he gets an initial of the client.
That was like the last question.
That was like the last question, but it's different. So the wording is different. So this is a good point that you make, because the real test is going to ask you for the correct, they're going to twist it on you. They're going to ask it to you different ways, but it doesn't matter. As long as you understand the rules, you're going to get it right. Right?
Mm-hmm. Could be.
All right, cool. Let's read B, C, and D because those are true, right? It's always good to learn from true things. Right. Read the things that are true, and don't read too much on the things that are not true, because then you're gonna think it's true. You know, your brain just accepts positives. So here's a positive. Draw a line through the first answer, record the answer, and have the applicant initial it. There it is. Note the application, the reason for the change. Destroy the application and complete a new one. Yeah, you could destroy it and start all over again. That's totally valid.
Oh, those are like if you actually mess up.
Yeah, if you mess up, you could do any of these 3 right here.
You're right.
All right, cool. If an agent fails to obtain an applicant's signature on the application, the agent must, again, same thing. Sign the applicant for the client? No. Sign the applicant stating it was the agent? Nope. Send the application to the insurer and note explain the absence signature? Nope. The only good answer is D. Return the applicant to the application to the applicant for a signature. Any questions?
They're all the same.
Which of the following is true regarding an application for a large amount of insurance? We talked about this. Large amount of insurance needs a medical exam. So A, look at A, what it says. The insurance might require medical examination by a professional. Yep. B says non-medical? Nah, I don't think so. Not for large amounts. C, the applicant must submit a statement of good health. I don't know. The agent is not the applicant will complete all of the medical. The agent, not the applicant. A looks like the best answer. There it is. See how that works?
You know, I got this one wrong. I was in between A and C, and I clicked C. So
C sounds like something, but it's actually bogus. C is like, what is a statement of good health? Let's talk about that. So when you submit an application with no money, yeah, with no money, and then the policy gets issued, so then you as a producer delivers a policy to the client, and you have to pick up money now because you submitted without money, right? So you pick up money, and then on top of that, you have to fill up a statement of good health. In other words, the client has to say, I'm still healthy. Todavía, I'm cool. I'm still good. Nothing has changed. My health hasn't changed. Really? No, yeah, really, really. Sign right here and make sure. You know what I mean? You need something in writing. That's a statement of good health. Which of the following statements regarding business overhead expense policies is not true?
A. Ooh,
Yep.
I hope you didn't hear that.
No, I like that answer. It's not limited. It's unlimited. B, premiums paid for the B business overhead are tax deductible. Yes. Benefits received taxable. Yes. D, lease equipment expense are covered by the plan. Yep. You're right. It is A. Good job. Which of the following includes information regarding a person's credit, character, reputation, and habits? This is a consumer report.
What's the difference between history and report?
History is just bogus. They're made it up.
Oh, okay.
Don't focus on that.
Oof.
A consumer report is it includes your personal credit, your character, your reputation, your habits.
Oh, wow.
Yep. Time out. Let's time out real quick, yeah? Hold on. ¿Qué pasó, be? Yeah, yeah. I like that idea. All right, babe, I'll do that. I have a 3 o'clock meeting, and right now I'm doing a meeting, so I'm not gonna be able to do it right now. Right now, I'm not gonna do the letters right now because I have a meeting, and then at 3 o'clock I have another meeting. I'll do them later, though. Okay, bye bye. Which of the following is not required on an illustration used in the sale of life insurance policy? Which of the following is not required on an illustration used on the sale of life insurance? Underwriting, not use the name of the B. Beneficiaries no se ponen in an illustration. Beneficiaries is a very confidential information. So ese se va a poner somewhere hidden inside the policy. If it's there. Sometimes it doesn't even show on paper because it's confidential. You don't want to know who. Like, there's going to be people that says, who's getting that money if that person dies? Nosy people, you know? So that's private. You know what I mean? It's private. So beneficiaries are not going to be readily available in a summary page or an illustration. You know what I mean? So just think about that. It's common sense, right? Beneficiaries. Yeah. That's confidential stuff. That's very private stuff. So that's not going to be on an illustration. Okay.
George me dijo, remember that? Oh, dang, he showed me this paper, and it's like a summary of what the whole thing is, pretty much. Consumer report? I think that's what it was. Is that what we would get instead of those?
I think he's talking about it's called the buyer's guide.
Oh, there you go.
Yeah, the buyer's guide. The buyer's guide is something that we have to give people when they buy a policy. And the buyer's guide basically shows comparisons of what is term, what is whole life, what is universal life, and the features and benefits of each of them.
Okay.
It's like a generic pamphlet that gives information about all the. It's like an educational booklet.
Would that be considered illustration?
No, an illustration shows numbers. It shows like, hey, look, these are the projected coverages. These are the projected cash value. This is the This is how much your payment's gonna be in 20 years. It's like numbers. An illustration shows numbers.
Okay, thank you. Oh, ya le pusiste record?
You know what? I didn't stop it. I didn't know how to stop it. Which of the following must be disclosed in all advertisement and policies of term life insurance for individuals 55 and older? Shoot. I think it's C. Yeah. Insurance monetary value index. This is a rare question. So chances of you getting this question is kind of slim, but hey, nope, you don't lose nothing in adding it to your brain. Using up one of your empty brain cells too.
Do you think one of your clients are going to stay that long?
Nah. What?
They said 55 now? Or that's if you start
the yeah. A lot of people live that long.
Oh, no.
What do you mean?
No, I meant
what do you mean?
I meant like, can you start that age on your life insurance? And that's what they would have to open up?
Yeah. You could start a policy till age 70.
Oh, okay.
Yeah. But yes, after 70, a lot of companies don't insure you anymore. Yeah, pues ya vas más para allá que para acá. If a life insurance policy increases significantly in a face amount, death benefit, when the insured reaches a specific age, what type of policy is this? Well, if the life insurance policy increases significantly in face amount, so death benefit, right? Coverage. I think this is a D. Jumping juvenile policies, you get it for your children, right? So like, let's say I get a policy for my 9-year-old daughter, and when she turns 21, the coverage is going to significantly jump up. That's jumping. There it is. Usually 21. You see that? Jumping juvenile. By the way, quick plug. While I'm recording this, I always say this every time because it's so freaking important and vital. Right now, pause it. This is how I want you to watch this video. Is pause it right now before I read the question and answer it. You try to answer it on your own. Maybe write on a piece of paper. And then play the video, and then watch me answer it and teach it so that you could get it and read the rationale. And then on top of that, once I answer it, pause it again and screenshot the right answer with the rationale. If you do that, man, if you dedicate yourself to studying like that, you're gonna pass. I guarantee it. People that don't do that have a hard time passing. Okay, here we go. Which of the following would be the beneficiary in credit life insurance? The creditor. The creditor, because he's the one that lends you the money. He's the one that needs to get paid back if you die. So he's a beneficiary. Make sense? If an agent wishes to sell variable life policies, what license must the agent obtain? Anything that has the word variable, you need what? Don't ever forget this, okay? Securities license. Anything that has the word variable, you need a securities license. To sell variable life insurance policy, here we go again. An agent must receive all of the following except a securities license, a life license, but it's accept. It's asking for accept. FINRA registration, the answer is D. SEC has nothing to do with getting a securities license. FINRA, yeah, that's the regulatory agency that gives you your securities license. And then, of course, this life license that you're trying to get, you need that too to sell variable products. All of the following are true about variable products except, here we go, variable products. The minimum death benefit is guaranteed. I think that's true. The cash value is not guaranteed. Yup, it isn't because it varies. It's variable. It goes up and down depending on the stock market. C, policy owners bear the investment risk. Yes, they're the one investing in the variable products. So the answer has to be D. Premiums are invested in the insurance general account. No, they're invested in the separate account. Anything that has the word variable también, everything that has the word variable is invested in the separate account. All right, guys? If you repeat this video over and over, you're going to get it and you're going to pass this test. Concerning juvenile life insurance, which of the following statements is incorrect? Juvenile life is classified as any life insurance purchased by a minor. No, it's purchased by an adult. That's the answer. It's purchased by an adult. So juvenile life insurance is life insurance on a minor. But who bought it for the minor? The minor can't buy it for themselves. The adult buys it for the minor. Make sense? Mm-hmm. So look at B. Usually a parent or guardian in the is the applicant for insurance on the life of the minor. C. It can be limited premium payment policy. D. Juvenile life is classified as any life insurance written on the life of the minor. Come on now. This is too easy. All the following statements are correct regarding credit life insurance. Credit life is life insurance that covers the creditor, that covers the borrower in case the borrower dies so that the creditor gets his money back. So benefits are paid to the borrower's beneficiary? Nope. Benefits are paid to the creditor.
Borrowers.
Make sense?
Borrowers and creditors, okay.
Yeah. The amount of insurance permissible is limited to per borrower. Yeah, it is limited to how much money they borrowed. Premiums are usually paid by the borrower. Yes. Benefits are paid out to the creditor. Exactly. Variable whole life insurance is based on what type of premium? Variable whole life is level fixed. Level fixed. So the premiums are fixed. But so what is variable? Variable is the investment. Variable is how the money grows. It varies. It goes up and down and depends on the stock market. Variable. You want me to show you what variable looks like? I want to show you what variable looks like, okay? So let me see if I could show you this. Bam. Look at what variable looks like. Hello, where is it at? Oh, crap. Okay. There it is. This is how variable looks like. There it is. So here's the Dow Jones. The Dow Jones goes up and down on its way up, right? You see how it varies? This is how variable looks like. It varies. It goes up and down, up and down, up and down. It's variable. Get it? That's how it looks like. All right, so let's continue. Which of the following is called a second to die policy? Survivorship. Second to die means that the survivor must die. So it covers two people. When the first one dies, it still keeps paying. When the last one dies, when the survivor dies, it stops. Second to die. Last survivor policy. Which rider, when attached to a permanent life insurance policy, provides an amount of insurance family member? This is called a family term rider. Family term rider. Screenshot it. Just have to do it over and over, and it'll se te pega.
I was like, can you open
it starts
that last
sticking.
policy? The
Survivorship? Yeah.
For your family?
Yeah. Yeah. Usually, business owners buy it for each other.
Oh, okay.
Yeah, like it's not really like in a family type of scenario. It's more like a business use.
Oh, okay.
An insurance purchase, a 10-year level term policy that is guaranteed, renewable, and convertible. What happens on the 10th year? Well, they could renew it for another 10 years, but a higher premium because they're older. Because they're older. So A says same premium? No, it's higher. B says higher premium. That's the answer. C is wrong too. Why? The insured must provide evidence of insurability. No, you don't have to provide evidence of insurability. It's guaranteed renewable. So your health doesn't matter. You're automatically qualified. It's just going to be more expensive because you're older. The insured may only convert the policy to another term. No, you could convert it. Converting it means that it goes from term to whole life or a permanent policy like universal life. Whole life is permanent too. Oh, I didn't answer it, huh? There it is, B. Which of the following is true about credit life insurance? Debtor is the annuitant? No. Creditor is the insured. The debtor is the insured. Debtor is a policy beneficiary? No, the creditor is a policy beneficiary. Creditor is a policy owner? Yep. That's it. Don't forget to screenshot. Don't forget to pause so you could answer yourself. Then listen to my reasoning, my rationale. That's how you want to do it, guys, all right? This is the last one. We got to move on. I have to prepare for my next appointment, but this is good. We're learning a lot here. The sole beneficiary of a life insurance policy dies before the insured. If the policy fails to change the beneficiary before the insured's death, the proceeds will go to the estate, the insured's estate. Oh, I messed up here. It's not the state of California. See, it's the insured's estate with an E in front. Estate. What is estate? Basically, it's the client's net worth. An insured pays an annual premium to his insured. In return, the insured promised to pay benefits in accordance to the terms of the contract. This is called conditional consideration. Damn it. Got this one wrong again. Consideration is a value of offer by the insured to the insurer and vice versa. Consideration. Got it. Which of the following components must a life insurance policy have to allow policy loans? It has to have cash value. If you want to withdraw some money, policy loans, you have to have cash value. Life, income, joint, and survivor settlement option guarantees income for two for more recipients until they die. That's it. Joint and survivor. It pays for two or more incomes until the last one dies, income stops. Which type of beneficiary is changeable at any point? Revocable. Irrevocable, you can't change it no more. That's it. If you put your mom as a beneficiary, as an irrevocable beneficiary, you can't change her no more. Unless your mom signs off. An insured and his wife are both involved in a head-on collision. The husband dies instantly and the wife dies 15 days later. The company pays the death benefit to the estate of the insured. This indicates that the life of insurance policy had what provision? The common disaster clause. Common disaster clause.
What is that?
Common disaster clause means that the both insureds died in the same policy. I'm sorry, in the same car accident, or kind of close to it. 30 days, within 30 days.
Oh.
Common disaster, the same car, common accident, disaster. For how long is an insurance company allowed to defer policy loans request? Oof. 6 months. Crazy. I know you want your money, Mr. and Mrs. Klein, but we're not going to give it to you until 6 months from now. That's crazy. They have your money hostage. When an insured selects the extended term non-forfeiture option, the cash value will be purchased to the term insurance of with what face amount? Extended term, same face amount. Equal the same as the original policy minus the cash value. No. Equal to the original policy for as long as the cash value will purchase. Yes. The answer is D. So extended term non-forfeiture option is going to use the cash value to pay for a term policy with the same coverage amount. It was going to end to age 100 if they kept making payments, but since they're not going to make payments, they're going to use the cash value to as the form of payment. Eventually, the cash value is gonna se va a acabar, right? It's going to end, and when the cash value is over, it's going to be before the age of 100. What happens when a policy is surrendered for its cash value? Coverage ends, and policy cannot be reinstated.
It's kind of common sense, huh?
There you go, common sense. Jay applied for a life insurance policy on January 10th. The policy was issued on January 31st. Jay's agent was vacationing at the time of policy was issued, so Jay did not receive the policy until February 18th. Ooh. Jay decides that he does not want the policy. Well, when would Jay need to return the policy in order to receive a full refund? This is a free look period. And they got 10 days. The answer is January 24th or 10 days after the policy is delivered. Yes, the answer is B. You got 10-day free look period. In this case, 10 days from the day the policy is delivered, which is February 18th. That's why B is the answer. What type of policy will most likely be established for a minor?
No.
No, Steve. Dang. I'm gonna say a trust. Uniform Gift to Minors Act. Uniform Trust to Minors Act. Trust.
What is that?
A trust
means in this case.
No, in this case, a trust means a paper that cannot be changed. It's money that is for the child and the child only. Nobody could touch it. Trust. It's like a will. Which of the following statements is true concerning irrevocable beneficiaries? Remember, irrevocable beneficiaries cannot be changed unless that beneficiary signs off on it. But why would he? He's getting the money. Why would he sign off on it, you know? Which of the following statements is true concerning irrevocable beneficiaries? They may be changed only on the anniversary date. Nope. They can be changed only with the written consent of that beneficiary. Yep, that's the answer.
You said it on the last question.
Yeah. That was a previous question about this, right? And not even on this chapter, I think. It was on a different chapter.
The last chapter.
So you see like how some of them are concepts are within the same chapter.
And the questions.
Yeah, so this helps.
Yeah.
This makes it easy for you guys to study it. Yeah. Yep. Hopefully that helps. If you have any questions, review this video. Just watch it over and over. And the videos that I have on the Telegram, they're gold, man. Those, I'm telling you, it's like having a professor. Unless you think my voice is like straight up boring and it puts you to bed, then I guess there's videos on this. Like here, if you go here on main menu, right? So watch. No, let's do this better. So we're gonna go to study by topic. We're gonna go to the next chapter, life policy writers. Look at this. There's videos here. So if you think these videos are more entertaining than me, post, you know, knock yourself out. Let's check it out.
Let's continue our conversation about features that modify coverages, and in this chapter, focus on policy writers. Here's a scenario. Because of a disability, the insured is unable to work, so he cannot pay for the policy premiums. Without the premium, there's no coverage. Well, the waiver of premium rider, for example, will allow the insured to keep the life insurance policy in force without paying the premium.
For free.
Here's another one. An insured purchased a $100,000 life policy with a cost of living rider. That means if the rate of inflation the following year is, let's say, 3%, the policy's face amount will also increase by 3%. As you can see, riders provide additional protection on coverage to the insured, but these benefits do come at a cost. You usually need to pay extra premium to add a rider to a policy. Keep these learning objectives in mind as you study the material in this chapter. Identify riders that provide benefits in the event of an insured's disability. Identify riders that may increase or decrease the death benefit. Know how long-term care coverage may be purchased. Know the education requirement for producers selling long-term care coverage.
They're very generic, these videos.
We'll cover a lot of information
in this
chapter.
They didn't get into details.
So take your time.
They're good. You see that? They're good, but they don't get into details.
No, yeah.
You see, like there's a lot of details on the waiver of premium. There's a lot of details, like you have to be disabled for 6 months, and it has to be a permanent disability. You know, and there's little details that these videos don't show, right? So these are good, but man, there's a lot, man. There's the resources are crazy, available, unlimited resources. So study hard, and hopefully this helps, and repeat the video over and over. Here's a good thing about videos. You can always rewind the video. It's a YouTube, well, not this one. I forgot to put it on YouTube, but YouTube, most of them are YouTube videos on the Telegram. So on YouTube, you could always, you could tap back and rewind, tap forward in the front and fast forward. So if it's a question that you already know, why review it? Just tap forward. See, this right here, live classes is the ultimate, is best, because you got me live. But what if we're studying something that you already know, and I'm studying with somebody else? You're gonna be like, I don't need this class. I already know this stuff. But with the video, you already know this stuff. Okay, forward to the part that you don't know. To me, it makes total sense to study with videos. But then again, that's my learning style. Everybody's learning style is different. So find out what is your learning style. Like some people have to read the whole damn book. Watch, pull out one of these right here. Let me stop the sharing. Check it out. Yeah, check it out. You see, some people learning styles, they have to read the whole damn book. Crazy. That's not me. I don't know if it's you, but you know, this whole book right here, it's a fat one. Look at that. It's a fat boy. So you could this whole book is in your You Can Pass courses, digital courses. So everybody's different, but just know that this exam is multiple choice. So on the videos, most of the videos, I go through multiple choice questions over and over and over, because that's what's going to be on the exam anyways. So anyways, man, hope this helps.